Today is July 12th, 2019. This is Forecast Free Friday. My name is Jay Coulter. My partner in this project, as always, is Clint Sorensen, the CIO of Wealth Shield. Today's charts are presented courtesy of Y Charts. They are offering a 20% discount on any subscription as long as you mention the Resilient Advisor podcast. Both Clint and his team and myself are active users of this service. Clint, this week we reached the halfway point. There's a lot of data to crunch, and dare I say, predictions and forecasts that can be made because, of course, I'm talking about baseball. Tell me, who do you like in the American League this year?
Probably. I don't really know. I follow the National League more, and so I'm definitely a big Cubs fan. So I'd like to say I want to see the Cubs win it all. I know the Dodgers are favored, so we'll see what happens there.
So I think out of this American League, I hate it. The Yankees buy the best team every year, and they're just stacked. I'd love to see the Astros steal it from them. In the National League, the sleeper is my Atlanta Braves. They're playing well.
You gotta give the Braves a little shout out if you're in Atlanta. That's true.
Absolutely, completely biased because the Dodgers, like you said, are stacked.
Yeah, they're definitely the clear favorite for the whole entire thing. But yeah, Yankees are always solid.
Yeah,
American.
And baseball is a great analogy for something I wanted to talk about. I think trend following could be a scam. Clint, change my mind.
Yeah. So, talking about the great trend followers, right? The owner of the Boston Red Sox being a trend follower during his day, and he did all right. I always say, look at track records. Look at the track records of the great trend followers throughout history, whether that be William Eckhart, if you look at Jerry Parker from Chesapeake Capital, if you look at Henry, right, from the Boston Red Sox owner, if you look at Salem Abraham. If you look at the track records of the great traders in the world, a lot of them were trend followers, and a lot of them have done phenomenal for a very long period of time. And I think the common notion, it goes back to Behavioral Finance 101 in this concept of anchoring, right? So investors, they anchor to the S&P 500 because that's what they see, right? That's the relevant information that's readily available to them in their memory. And so that's what they anchor every investment strategy to. Well, trend following is not the S&P, right? Trend following is buying what's strong and selling what's weak, or buying what's going up and selling what's going down. And, traders have done well and built a significant, amount of wealth following that type of strategy for a lot of years. And so I don't think trend following is a scam. I think it's just a strategy. And I think it's a strategy that's been proven to be robust. And it's just like baseball, right? Think about what the best hitter, all-star hitter, probably batting 300. Right. And it's very similar in trend following. Trend following says, hey, I'm going to take these positions, and I know that I can be wrong 70% of the time and still make money if my losses are only 1 times the size, or if my wins are 3 times the size of my losses. If I'm taking very small losses and I'm letting my winners run, the very notion of trend following, then I can be wrong more than I'm right and still make money in some markets. And I think that's important. And at the very core of trend following is also this concept of diversification. Trading anything and everything you can trade, right? If there's a market for it, and you can show that adds value to the portfolio by diversifying it, that makes a robust system. And so I think that's why I believe so strongly in it, and that's why I'm a fan.
So, Clint, scam's a big word. So my experience with trend following in my 20-plus years working with advisors is running across advisors that claim they do trend following, say they have a process in place, but then in 2000 and 2008 and 2009, their whole process blows up. And of course, I haven't done a deep dive on why it did, but it seems to me as much as there is upside and potential for it, there's a lot of risk. But one thing that got me to thinking about the way I look at trend following was an article actually that your team sent out from Alex Bryan over at Morningstar ETF Investor. And it talked about the way trend following could actually help you cut your risk. So let's take it down to the financial advisor level. How can an advisor today implement trend following into their models to help reduce the risk as opposed to looking for the outsized alpha?
Yeah, absolutely. And I think one of the things you saw that probably pushed you more to into the skeptical camp is that trend following, the way advisors have often claimed that they follow, right, is discretionary. At the end of the day, they're still pressing a button making the decision, and it's based on an arbitrary set of rules that they can follow or may not follow. The trend following I'm talking about is systematic, diversified trend following. And the key word there, there's several, but the key word is systematic, meaning
tell me about
the rules are well defined, they're codified, all buys and sells are taken no matter how you feel about that position. That makes trend following very challenging. And the reason I think it'll continue to work and continue to be robust is because you go through periods where it's not favorable. Just like buy and hold investing is a system, right? Buying the S&P 500 and holding that forever is a system. It's weighting the highest market cap companies. There's going to be times that doesn't work so well, and there's going to be times it does. And, I think the discipline to stick to that system is the important thing. And for me, trend following is an easier system to stick to because of the risk reduction component that article featured. Essentially, what you find is that it doesn't add any value to the upside if you're comparing to the S&P, right? What it does is it chops off what we would call that left tail, right? The negative returns, the outsized negative returns, because by definition, any system in trend following is going to be taking small losses. So that's the whole notion. You get out quickly, take your small loss, and then you allow your winners to run and make outsized gains on the upside. Those very few or small percentage in winners end up making up for all the small losses. And that's the idea.
So in application, would it be a prudent practice to pair trend following with a buy and hold strategy and make that allocation based upon an investor's risk tolerance?
Absolutely. So I actually I think it allows for a client to have more in equity, which is great. And so if you say, hey, someone's got a moderate risk tolerance, well, I can dial down the standard deviation. Not a big fan of that as a risk measure, but I can dial down the historical max drawdown, or I can dial down the downside deviation, so deviation below zero. So think about the negative returns. Mm-hmm. I can dial that down by adding trend following. And I think that does make a lot of sense, because instead of using fixed income, I can use trend following, which may or may not be a drag on performance. And there was a Deutsche Bank paper, I forget when it was published, maybe 2013 or so, and it talked about the optimal weighting to trend following. And it was 51%, which I thought was interesting. Mm-hmm. And so, most end clients can't handle that because it's not going to look like the market. And again, that anchoring causes them to make bad decisions when it goes through a period of lagging. Mm-hmm. But optimally, I have no reason to argue with that paper. I think trend following should be a good chunk of an overall portfolio because of those risk reduction benefits. And it allows you to participate in the long-term compounding of the market without really worrying about, down markets per se. And so I think it provides for a better, smoother path for a typical investor.
Yeah, where I've seen it really get advisors in trouble is when they run their whole firm, all the accounts based upon a trend following, and then it's out of favor for a long period of time, and then they start losing clients, and then they change their model. They change their approach. As right as rain, and just like a clock is right twice a day, that ends up happening over and over again. So I think the big takeaway for viewers is that if you're going to look and implement trend following, it's not meant to be comprehensive. It's a part of an overall investment solution.
That's right. And that's largely because just behavioral makeup of the end client. Right. I think that's the sole reason. We were just having this chat earlier I was talking amongst our director of research and one of our analysts, and we were talking about the need in an account to have a mix between trend following and traditional assets, because if you have a single account all in trend following and it lags, that client's going to have this microscoped on this account. It may end up acting irrationally and abandoning it right at the wrong time. And so I think you're right. I think you have to have some sort of mix. It's a great combination with what they're anchoring to. And again, back to one of my favorite sayings, which I'm sure you're sick of hearing, but what's behaviorally optimal is not what's mathematically optimal all the time. And so I think this is one of those cases. Trend following may be mathematically optimal for an entire portfolio, but at the end of the day, it's not always behaviorally optimal. It just depends on the end client.
Excellent. Clint, thanks for coming on, and I hope we have a Cubs-Braves National League championship to talk about in the fall.
Absolutely.